We have so many retailers this week and next week as well. So we're taking a chance to spotlight a couple of them right here. TJX, that's the parent of TJ Maxx, and also Marshall's and Macy's. Joining me right now, Zach Waring, equity analyst at CFRA. So let's take a look here. You have a sell rating on TJX and a $100 price target. Why a sell?
We have the sell rating strictly on valuation. We do think TJ Maxx is a great company. They put out a great product. We just think valuation's a little bit ahead of itself here. It's trading at 26 times next year's earnings. And, for that company, typically trades in the low 20s. And pre-pandemic was actually below 20 multiple. So, we think there's limited upside here with shares priced for perfection.
Well, how will it get to a below 20 multiple? I mean, to try and go back to the olden days. Will it ever?
No, we don't expect for it to go below 20. We think it's a really good company. They've got, they're able to open about 150 stores a year. We think the multiple should be more in the lines with like 22 and a half times forward earnings. And right now it's trading at above 27 times. So that's a high for the company over the last 10 years. Outside of the pandemic. And so, we just think there's little room for margin expansion. So gross margin and operating margin, because of their business model, there's not much room to the upside there. And we think expectations for next year are really high. So we've got, expectations high, valuations high. And so we just think, there's some room for some cooling here.
And it's at a record. I mean, we're going to see a record close here maybe for TJX, so that's exciting. I mean, Target pulled out of a rut, people are saying, right? Macy's didn't. We'll get to Macy's in a moment. But TJX certainly is impressing folks, at least with the quarter. Were you impressed with some parts of the report for the quarter?
Yeah, so they had growth in home goods, which was pretty impressive because you've seen that category really struggle over the last few years. After the pandemic, you had a lot of pull forward demand during the pandemic. So that was really good from home goods. And then you had pretty, consistent growth across the board, which is always impressive for a large company like TJ Maxx. We think that, they're a great company. They're executing well. And we think investors and analysts are kind of crowding into this name because they're worried about the consumer. And this is kind of a safe play because they're off price. They sell products at 20 to 60% below, retail price. So, we think there's a little bit of crowding here, and we think, shares are due for a cooling period.
Yeah, and look, they raised their guidance going forward. That was good news for the company. Last but not least, last thing on TJX that I'll say is that they keep talking about the global footprint. They certainly seem to feel very comfortable with their big picture story.
Yeah, and they just invested in a company out of Dubai that does the same thing. It's the only player in that location a very small investment for the company of this size. So only about $360 million invested for a 35% stake. But that's that's kind of part of their strategy to grow in that region. So they do have some growth long term, and they've been doing this for years now. They open 100 plus stores a year. So they've kind of got that to, kind of pad sales. So they don't have to have, really consistent comparable sales growth at their stores. They can kind of open stores and rely on that for some extra growth.
Yeah. All right, let's get to Macy's where you have a hold. What went wrong? I mean, it's been down between 12 and 16% today.
Yeah, I think for Macy's, it's just, valuation over the last 3 years has been kind of stuck in the 6 times forward earnings range. And their earnings have kind of declined. So you've had that issue over the last few years. So I think in order for Macy's to turn it around, they're going to have to turn around their earnings picture. I don't think there's much room for multiple expansion here. The shares have typically over the last 3 to 5 years traded between, 6 and 7 times forward earnings, which is what it's at now. Expectations are pretty low here, but we just see a lot of, headwinds for this, category of department stores. Obviously they've got really large stores, which are no longer, in for the consumer. Consumers like smaller stores. They like to shop direct to consumer. So they're battling that, that headwind as well. So we just think, shares are probably fairly priced here. They're around their 3 and 5 year forward average, and we think neutral is probably the right move here.
Yeah, what's interesting is that, we did see at least some parts of the Macy's story. You're looking at the price target here. You have $17 from $19. That's your price target there. What was your price target on TJX? I was thinking about that. You have $100,
100
right?
on TJX. Yep.
So, is Macy's doing anything right at this point, or because people are looking for a lot of bargains, it seems?
Yeah, so we actually think that Macy should take a play out of Dillard's playbook. So Dillard's over the last 5 years, since the pandemic, they really haven't pivoted at all towards the online or direct consumer or any of the opening new stores. Dillard's is really just focused on operation efficiency. So they've really just worried on how can they get more efficient, how can they drive margins higher, and then they're also focused on buying back shares. And they use basically all their free cash flow to buy back shares. So we think that's the move for Macy's. We think if they can start, really focus on efficiencies and then buy back shares with their free cash flow, we think that would help.
Do you feel like the consumer is strong and that there are really some players that are at a wow moment? I mean, do you have any buy ratings, Zach?
We do have some buy ratings, but most of our buy ratings are on companies that have been beaten up really bad this year. We don't think the consumer's in a great place. They're obviously holding on and kind of, they're stable, we would say. But we don't see, a return to 2021 growth, 2022 growth anytime soon. We'll see, the Fed's looking to cut rates. We'll see if that helps. But we do think the consumer is in a little bit of a shaky place here. We do like Nike. We think, the valuation fell off a cliff there. Shares were trading around 72 times forward earnings. And we went to a buy. We thought, it's kind of been overdone. We think a lot of the themes that people were stating, competition we think is there, but we think, Nike's a great company with a really strong balance sheet. They're a global brand. So we upgraded that name, and we really love Lululemon here. Lululemon trades at a steep discount to its 3 and 5 year average. We don't think it'll trade back to that average again. We just think growth's slowing in the U.S. But we do think there's plenty of upside for Lululemon because of the significant pullbacks. I think shares are down 50% year to date.
Yeah, Zach, thank you so much. Nike and Lulu, some of your buys there. Appreciate it. Great chat about TJX and Macy's and a few others. Zach Waring of CFRA. Thanks, Zach.